The novel coronavirus is spreading rapidly in countries outside China. The fear of not being able to eliminate the virus has spooked the global equity markets, including India. The benchmark S&P 500 index, which measures the stock performance of the top 500 US companies, corrected around 13% between 19th and 28th February. S&P BSE index lost 1,448 points on February 28th alone, wiping out close to 5.5 trillion rupees of investor wealth. Yesterday, the market fell another 150 points and volatility is expected to continue for a while. You've tuned into Why Not Mint Money, and I'm Disha Sanghvi from Mint's personal finance team. On this episode, I'll try and help you understand why the markets are fearful and how you can deal with the current situation in terms of your investments and travel plans. So what really is the fear? Global markets have tanked on the fear of coronavirus spreading outside China at an alarming rate. What started from Wuhan in China has now spread to about 58 countries. The shutdown of production units and quarantine towns in China has hit economic activity and in turn the growth of the country. According to an industry report, China's GDP is expected to decelerate by 1 to 1.25 percentage points over 2020 due to halting of economic activities in key production centers. This will further have an impact on global growth. People may curtail discretionary spends on travel and other things which will impact global growth. This can be confirmed by the fact that many airlines have cancelled flights in the affected regions and airfares have been slashed considerably. A one-way flight from Delhi to Rome, which cost 32,371 rupees in March 2019, is now available for as low as 26,345 rupees, a drop of almost 19%. Flight fares on the Mumbai-Singapore route have seen a significant fall as well. What was priced at 26,000 in March last year will cost just about 8,700 if you were to book a one-way flight this month. Fares on this route are down by a huge 66%. Experts said fares are dynamic and based on demand. Fares go down as the demand goes down and vice versa. The pricing movements are a reflection of how customer demand has reduced due to the travel restrictions imposed by many countries, low demand for corporate travel due to travel bans advised by many organizations, and subdued demand sentiment for leisure. There has been a 30 to 60% drop in bookings in China and some other countries in Southeast Asia ever since coronavirus cast its shadow. The market volatility can be worrisome, but long-term investors need not fret. Experts we spoke to said the correction is warranted because the markets have rallied a lot. They said global equity markets, including Indian markets, have rallied a lot driven by surplus liquidity. The COVID-19 epidemic is a good enough reason to witness a correction. This can be substantiated by the fact that global markets had corrected 5 to 12% during past epidemics such as Zika and SARS. Experts, in fact, believe that there is more room for correction this time around. Markets are mostly correcting on expectations of supply shocks given the disproportionate dependence of the global economy on goods from China, which could get converted into demand destruction or deferment, further hitting global recovery. Markets may also be fearing that these developments could lead leveraged companies to default and create non-performing assets in the global banking system. But this is most likely a temporary phenomenon, which was the case during earlier epidemic breakouts. For instance, the US S&P 500 lost 3.6% during the SARS outbreak between January and March 2003, but gained 33% a year after the outbreak. The BSE Sensex lost about 10% during the period, but gained a huge 83% after the outbreak. Similarly, during the Zika outbreak between November 2015 and February 2016, it fell around 6% but was up more than 21% a year after the outbreak. The BSE Sensex lost about 13% during the Zika outbreak but was up 24% a year later. Experts say there is no need to panic in such situations because markets regularly go through such cycles. In fact, you could use this opportunity to invest for the long term. However, stay away from direct stock investing if you don't have the wherewithal to research each company and make a decision. Instead, you could invest through mutual funds where your fund manager will do all the research on your behalf. Financial planners said market volatility helps you build wealth over a period of time. So continue disciplined investing through systematic investment plans and stick to your asset allocation. If you have the money, use this opportunity to invest more. When it comes to your travel plans, we recommend not getting tempted by the dropping airfares because it is difficult to predict when the situation will improve. If you do want to travel in the next few months, domestic destinations may be a better option, but be careful because a number of coronavirus cases are now being reported in India as well. If you really want to travel abroad, you could consider destinations such as Sri Lanka, Mauritius, the Middle East, Maldives and South America, which remain unaffected as of now. Nevertheless, monitor the situation closely for the next few weeks before you plan a trip abroad. On a lighter note, this could actually be a good time to postpone that exotic vacation abroad and instead use the money to invest. Once things stabilize, you could pat yourself on the back and take a stress-free break. That's all from us on this episode of Why Not Mint Money. Thanks for tuning in.